Hello, folks. Welcome to Pro Trader Strategies. My name is Eric Wilkinson, and this is Spotting the Trade. I'm going to get you what you need to know right before you go, and that starts out with the economic data, see how that's impacting the market. We'll sprinkle in some geopolitical fodder in there to round it off to see how the markets will react going forward. Well, let's talk about the economic data here in the United States. We've been getting some pretty decent economic data. We remember these manufacturing numbers we've been seeing, whether it's Philly Fed or the Richmond Manufacturing Index, which is what we got today, coming in at 13, expected to be 2. So manufacturing really strong right now. We also got across the pond this morning, we got some inflationary data, and that was in the form of PPI. Remember, PPI is producer price index. That's what the producer, the manufacturer, is feeling. And whether or not he can offset those higher prices to the consumer should show up in the consumer price index. So with that said, let's get on with the PPI in Great Britain. The input was higher than expected. That's showing the inputs to the manufacturing process were elevated, coming in at 1.4%, expected to be 1.2%. Now, the output, this is starting to see whether or not we can pass this on to the consumer, at least in the manufacturing sector in Great Britain, coming in line with expectations. So while the manufacturing sector in Great Britain is feeling higher inflation, they're not really able to offset it so much through higher prices. Now, when we go over to the core CPI, remember consumer price index will have food, alcohol, and energy stripped out of it. So that's when we get that core reading. We want to rip out some of those volatile aspects, because think about it, when we have a drought or something like that, we'll see food prices start to spike. So we want to kind of compare apples to apples in that sense. So core CPI, ratcheting up just a little bit to 5.2%. And then we also saw the consumer price index, the regular number with that food and energy added back into it, coming in at 6.2%, expected to be 6%. So while they were hotter than expected, both in line, leading us to believe that really food and energy is not driving inflation at this point. So is that really transitory? Is how you're supposed to really kind of peel back that onion around the consumer price index. Now, we also get crude oil inventories here in the United States, leading index, the CB leading index, home sales, Fed Governor Powell speaking. It's going to be a pretty busy day. We also got a lot of manufacturing PMI numbers coming up on Thursday. So keep your eyes out for that. That's going to be more across the pond related, but it will impact us here in the United States. So let's get on with the markets and see what's going on there. Crude oil continuing to make that trudge back after testing the 50-day simple moving average. Didn't last outside of the $100 a barrel mark very long. So it looks like $4.50 is here to stay for fuel prices anyway, for the near term. With crude oil continuing to climb, it's probably not going to pull back too much. Even with inventories, last week we saw higher inventories, but the manufacturing sector and the belief that the manufacturing sector and the economy starting to move forward here is going to be the overarching theme there. Now, let's take a look at bonds here. Now, you guys know I've been talking about sell the rips, buy the dips, especially in bonds, because price and interest rates are inversely correlated. With that said, we can't expect the bonds price to go higher, because if the bond price is going higher, folks, that means interest rates are going lower, and that's not the environment we're in right now. But when we're looking at this as a technical setup, this would be something that, had you sold those covered calls, it would be a time to look to get out of that covered call strategy. Why? Because it looks like we're just bottoming. Now, I'm a little bit early. You might want to wait for a confirmation to the upside to get you to pull the ripcord on your covered call strategy. But I would look to do that a little earlier, because we do expect bounces here and there that are not necessarily going to be what reality is saying. Just like when we saw this spike the last time into the 160s, there's no way we were seeing that was the time to start selling calls. So now that we're finding this bottoming pattern, we probably will get a little bit of a relief rally. I'm not saying that we're going to continue to move higher here in the bonds, but it's the opportunity that we're looking to cover this trade. And if we get that move higher again, we can add another layer of covered call strategies. So it's not always about just put it on and sit. You can trade around these types of strategies And when it looks like the market is starting to shift in momentum, that would be the time to look to cover some of those strategies where we were selling the rips and buying the dips in bonds here. These are the bonds, the interest rate. All right. Gold futures, while testing this trend channel again, and what happens to line up with the previous all-time high. So that previous all-time high, I think, is going to be a little bit more overarching because people have that number more in their head than this trend channel here. So we're going to see this support on this line really start to probably be more of a strength indicator than necessarily my trend channel. But the trend channel is working out pretty nice right now at this point. Bitcoin's still struggling, but again, we are right between that point of control. We really need a catalyst to get Bitcoin moving, whether it's Elon Musk. I think that's a little long in the tooth at this point, but to get a catalyst to get this moving to the upside is something that I don't see happening at least anytime soon. One of the big overarching worries here is if the SEC starts getting involved and regulating this product, well, that would be a good thing because I think it would get more institutional traders in there and maybe kind of balance out some of this volatility we've been seeing. Now, VIX starting to move higher. We saw a nice couple of moves the last few days. As a matter of fact, it erased all of those topping patterns that I was talking about in the equities. So while Dow Jones Industrial Average right here is at the point of control, broke that pattern. I would say that there is no pattern setting up right now in the Dow Jones Industrial Average. We can see here NASDAQ blasted off through the 50-day simple moving average, completely erased that topping pattern. So risk is to the upside now that we're above the 50-day simple moving average. As a matter of fact, I think we probably are getting some type of a cross at this point where the 200-day is starting to cross over the 50-day. That would be a bearish long-term trend, but I don't think that that's where we're at right now. I think that right now we're right where the market is perceiving value. E-mini S&Ps again yesterday erased that topping pattern. So risk right now to the upside in equities as the shorts are on their heels. And we can take a look at the breakdown of the E-mini S&Ps. Overnight's pretty bearish, but overarching seems very bullish in the market. Risk assessment, I'd be worried about the upside a little bit today. All right, a couple of trades that I'm looking at covering are my short calls. Still haven't gotten out of those. ConocoPhillips, Yum Brands. Yum Brands not working out too great. As a matter of fact, I'm short the 120 calls in there that expire in like 22 days. Those short calls are making money for me right now, but it is a little bit close. So I'm going to be very itchy on the trigger finger. It's not going to be the percent profit I normally look for there. Now, ConocoPhillips, we've been looking to sell covered calls on that. Remember, we sold some puts to get long in this trade. So I'm long at 80 from selling puts, lowered overall cost basis by about $3 or $4 in this trade. But with that said, I am doing the covered calls just like I've been talking about. Sell the rips, buy the dips, especially with the high volatility we were having. ConocoPhillips was a great one for that. We were trading up here at around the 100 level. I was able to do covered calls at the 120 strike. Now, 120 strike is what I'm looking to cover. So I got about $1.35 for that. They're trading about 20 cents. I'm working a 15-cent bid right now. We'll have to keep our eyes on that. But all those covered call strategies I'm looking to cover as of today, just because it feels like the market momentum is starting to shift a little bit here. And that's it, folks. Check out the webinar. Smash the like button. The webinar is tomorrow, Thursday. We're going to be doing cracking the code to trading options. So please check that out at Pro Trader Strategies. And if you can't take that, take it easy.